The stock market has fallen again today, and we are witnessing a continued persistent downward force applied to virtually all markets. The Fed has gone according to plan, and yet the market simply can't believe it. They thought the party would always continue. Free money forever. Until it stops pumping. The central banks around the world are intentionally collapsing the markets in order to create a crisis and take full advantage of. You came here for the truth, so let me unveil that for you. Today I'm going to do a full breakdown of exactly what happened in the markets. I want to show you what has occurred over the last little while. I think it is extremely important to pay close attention at all of the technical indicators so that you can measure this for yourself and be able to make assumptions as to where this is going to go over the next few days, over the next few months, and so on. So let's begin by taking a look at the markets themselves. You can see that everything practically is in the red. The Dow Jones fell below 23,000, and although it was suggested that this would be impossible, that we would see new highs throughout 2018, you could see where it has gone. The Dow Jones fell 464 points in this one trading session. You're looking at the Nasdaq and the S&P also down about 1.5%. So this shows us the weakness here that has been persistent throughout the US markets, but in fact it's really all over the world. In this article, it talks about the Nasdaq, which I think is really important because it is now down almost 20% from the peak that it reached in August. Everybody was suggesting that the Nasdaq was the new frontier, that tech stocks could defy the rest of the market, and that was the case from basically the beginning of the year up until, let's just say, September-October timeframe. But that all changed. As soon as October hit, everything fell. Every stock seemingly was hitting new lows, and right now there are countless stocks at their 52-week lows, and we are being told that somehow everything is fine. Well, it wasn't up until December that the market was going to really suggest it couldn't turn around from this point. Before that, all throughout October, all throughout November, there was this constant projection that it would turn around. So far, that's not the case. We are now heading towards the end of the year. That will make it 3 months in a row of very bad performance. So we'll see where it all ends up. December's Dow performance, point change in the Dow Jones, and you could see each trading day how it has gone, and there's a lot more red, and in fact the red seems to be a lot more significant as well. One day it dropped 799 points alone. The best day in December has been up 288 points. So this has been one of the worst months right now, and in fact it only seems to be getting worse. There's so many issues that are piling up on top at this time. The S&P 500 is just a few percent away from a bear market. That's how bad things have become in the US today. This is the true money supply. I don't have enough time to get into the details and break it all down, but essentially what we're having is the same repeated pattern that we had leading up into the financial crisis. All right, so this is just one more indicator, and here's another one: the true money supply year over year. And of course, every time this happens to fall, we encounter the same issues over and over again. As soon as liquidity dries up, the market crashes. You do not need to be a genius to figure this out. It's very obvious. As I've always said, as soon as the central banks stop printing money, the market's going to fall. If they decide to print more money today and they start to engage in QE4 and the ECB steps up their monetary easing policy and so on, then of course it could increase. Doesn't necessarily mean it will increase. Depends how that works, and usually there's a lag time in between when they start printing to it actually moving around in the markets. But regardless, that's what occurred. You can see it very clearly in 2018. It's been obvious. Poor liquidity has likely exacerbated the drop in equities. That basically just took the words out of my mouth. But we're looking at a record low in terms of the liquidity in this case here. And we are inching closer and closer to the yield curve inversion that everybody is waiting for, the 2 and the 10. And this is something that we have been watching with the other indicators, and this one happens to be the king of all of them, and it's almost there. It's not going to take much more time in order to get there, so let's see how long it takes. Global, systemically important banks, all of the too big to fail banks are getting punished right now, absolutely punished throughout 2018. This is in fact beyond the bear market, and it is into insanity levels in the GSIBs. We're looking at everybody from Citigroup and HSBC and so on. All of these companies here are so deep in the red. How they're ever going to get out without a bailout is beyond me. I have no possible way to explain any way that you can increase your stock, a stock like this, by about 50%, let's say. It's just not going to happen, not without some major intervention by central banks. This is the oil price, WTI crude, sitting at 46.57. It's been punished recently. As you can see, over and over throughout 2018, it has been finding itself in uncharted territory. We saw it increasing dramatically, and why? Well, it doesn't matter, because the next day, they're going to change their mind. There's a glut one day, there's no glut the next day. There's a stockpile one day, and then they'd have a shortage the next day. It's ridiculous. I don't believe it ever. I think it's complete manipulation of the price. It is an incredibly important commodity, and so you see that manipulation on a regular basis. This is just paralleling what we saw from 2007 to 2009 and what we're seeing today in 2018. It happens to line up, but they can do this in any way. Of course, it doesn't really mean too much, but I do think that there are some very interesting similarities in between 2007 to 2009 and present day. And that is simply that we are entering into a tightening cycle. And that's what's key. That is what is the most important factor. If the central banks are tightening, the stock markets fall. The S&P Banks Index has fallen to levels not seen since 2016. I continuously show you this one, and as well as the global systemically important banks. Both of these have been punished, moving back into the levels from 2016, erasing all those gains, all of that quantitative easing, all of those stimulus packages are just being erased, completely gone. What a waste. Well, that's where we're at today. And looking at the world's market cap has been dragged down by $16.7 trillion since the beginning of this year. Now that is a massive amount, no matter how you look at it. Yes, we can look at the amount of money that's out there, and 16 trillion is nothing in comparison to the total quantity of money. But when you just see the world market cap, which they're measuring at what looks like about $87 trillion, and to subtract 16 trillion off of that, it is very significant. Okay, couple quick ones here. Just wanted to show you that Deutsche Bank has fallen to €7. €7 now. This has hit another record low. We are witnessing an absolute punishing of this particular stock when we're being told, don't worry, tomorrow it's going to be fine. This is losing so much market cap right now. There's no way they're ever going to get this to come back without intervention by the central bank or the government. It's just simply not possible at this time. The Shanghai Composite Index is down 30% from its peak. It has been another one of those markets that has been just absolutely destroyed, as well as the Japanese stock market. You're looking at it going in the negative also. So this is just showing you that no matter where you look, no matter where you turn, we are witnessing stock markets around the world. We are seeing assets declining at such a rapid rate, and yet they're not willing to admit the truth that the weakness has prevailed and that it's only going to get worse until they intervene in the markets. It doesn't seem to be happening because of what the Federal Reserve has said. The central bank is simply waiting for the market to crash so that they can purposely pose as the saviors, create this solution to the problem, which is them buying up all the assets, and they're going to do so with the public's permission. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, you are supporting supporting this channel. So I do appreciate that very much. If you want to help me out, you don't have to do anything except just hit that thumbs up button, hit that like button. It really helps me out. If you want to comment on the channel, that really helps me also. If you don't know what to say happy birthday, all right? And last but not least, if you want the financial education you were not taught in school, these two books have it all. You can get everything you need to from A to Z in these books. So check them out at the link in the description. And if you want the audiobook, that's available at themoneygps.com.